Real Estate Deep Research Report, February 14, 2026. Disclaimer. This report is not legal, medical, financial, or official advice. These are news stories, not instructions. Do not treat any anecdotal reporting as advice of any kind. 1. AI-driven market shock, real estate as the new fear trade epicenter. Macro context. AI-driven selloffs have now spread from SaaS and financials into commercial real estate, CRE, and logistics, triggered by new automation tools like algorithm holding semicab. Investors are pricing in a future where AI compresses demand for physical space, labor, and traditional CRE services. Deeper structural forces. 1.1. Office real estate's existential risk. AI-enabled remote work optimization reduces the need for administrative office space. Musk's public comments predicting empty office towers accelerated bearish sentiment. Vacancy rates in major metros were already elevated, AI compounds the structural decline. 1.2. Logistics real estate under pressure. Semicab's orchestration engine optimizes freight routing, reducing idle truck time. Warehouse dwell time. Required square footage for staging and cross-docking. This implies less demand for industrial space per unit of freight volume. 1.3. CRE services disruption. AI is automating valuation modeling, tenant-landlord communication, predictive maintenance, lease abstraction. CRE service companies, traditionally labor-intensive, are now seen as vulnerable to margin compression. Investment implications. REITs with heavy office exposure face multi-year repricing. Industrial REITs remain strong long-term but face short-term volatility. AI-native CRE firms may become acquisition targets. 2. Hyper-localized housing market, the 2026 reversion to microeconomies. 2.1. Why localization is returning. During 2020 to 2023, national trends dominated due to pandemic migration, national mortgage rate shocks, uniform supply shortages. By 2026, these forces have fragmented. Drivers of localization. Divergent job market recoveries. Regional zoning differences. Localized inventory surges, Sunbelt, versus shortages, Northeast. Migration reversal in some metros. Wage-to-home price ratios diverging sharply. 2.2. Buyer versus seller power varies by zip code. Examples. Buyer-friendly markets, high-inventory metros with new construction oversupply. Seller-friendly markets, coastal metros with constrained land and restrictive zoning. 2.3. Agent strategy shift. Agents are abandoning national narratives and returning to block-level comps, neighborhood absorption rates, micro-inventory tracking, localized mortgage rate buy-down strategies. 3. Real estate M&A, post-Compass Anywhere consolidation era. 3.1. Why M&A is slowing but deepening. The Compass Anywhere merger and Stone Point's investment in Keller Williams reshaped the brokerage landscape. Now, firms are prioritizing integration quality, margin repair, technology consolidation, back-office unification. 3.2. Expected 2026 M&A patterns. 1 to 2 major national acquisitions. Dozens of regional roll UPS. Conservative valuations due to margin pressure. Increased due diligence on tech stack compatibility. 3.3. Strategic drivers. Brokerages need scale to afford AI tools. Organic growth is too slow in a low transaction environment. Firms with strong training systems and tech adoption will dominate. For CRE disruption mirrors early e-commerce retail collapse. 4.1. Historical parallel. Analysts compare today's AI CRE disruption to 1999 to 2005 retail collapse. Big box closures. Mall vacancy spikes. AI is now doing to CRE services what e-commerce did to retail. 4.2. CRE services under direct threat. AI is automating appraisals, market analysis, lease management, tenant screening, maintenance scheduling. This reduces headcount needs and compresses margins. 4.3. Office real estate collapse accelerates. Office REITs are among the worst performing sectors as remote work stabilizes. AI reduces administrative headcount. Companies downsize footprints. 5. National housing stress indicators, crisis signals intensify. 5.1. Foreclosures up 32% YOY. Tourism-dependent states lead the surge due to seasonal employment volatility, high short-term rental saturation, insurance cost spikes, property tax increases. 5.2. Buyer ghosting phenomenon. Buyers are backing out of deals due to rate volatility, inspection surprises, insurance premium shocks, fear of overpaying in unstable markets. 5.3. Negative equity zones. Some metros show 10% plus of homeowners underwater, driven by pandemic-era overbidding, insurance-driven price declines, climate risk repricing, local job market deterioration. 6. Homebuilders consider 1 million entry-level Trump homes. 6.1. Why builders are pivoting. Entry-level housing is the most undersupplied segment in the U.S. Builders are responding to political pressure, massive first-time buyer demand, decade-long underbuilding, high land availability in growth corridors. 6.2. Economic impact. 1 million new entry-level homes would increase inventory, reduce price pressure, shift investor strategies, expand suburban and exurban development. 6.3. Capital gains tax reform discussions. Lawmakers are exploring updates to primary residence exclusion, investor tax treatment, 1031 exchange rules. These could reshape investor behavior. 7. Institutional homebuyer restrictions, a structural market shift. 7.1. Executive Order Overview. The new order aims to limit large institutional purchases of single-family homes to prevent the U.S. from becoming a nation of renters. 7.2. Market impact. Investor-heavy metros may see price normalization. First-time buyers gain relative leverage. Single-family rental REITs face regulatory uncertainty. 7.3. Long-term implications. Could reduce rental supply in some metros. May push institutions toward build-to-rent communities. Could trigger legal challenges from investor groups.